15 seconds. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Michael Normyle. He's Nasdaq's U.S. economist. We're going to take a look at if we are truly in a recession and if it is more than just about that GDP print that we finally got. It's finally here. Before we get into that, though, let's review the market action that we saw coming over the past week.
Sure. So it's actually been kind of an interesting journey to nowhere this week, where it's been up and down, but markets are kind of flat. There was a sell-off on Tuesday after Walmart issued a profit warning saying that inflation is impacting consumer spending. But then on Wednesday, we saw a bounce with Alphabet and Microsoft having less disappointing earnings than expected, and then also boosted by Chair Powell yesterday saying, they're going to slow their pace of hikes at this point and that he doesn't think we're in recession. So that kind of balanced things out a little bit.
All right, so we got the print this morning. It's the second negative quarter that we've gotten in a row. You can argue whether we're in a recession or not. Technically, I guess we are in a recession. But in your notes this morning, you're saying that it's more than just the GDP.
Right. So the kind of two down quarters of GDP, technical recession definition, isn't what we officially use in the U.S., since the NBER is kind of the official arbiter of recession in the U.S., and they look for basically depth, diffusion, and duration for downturns in indicators of output, employment, income, and sales. So output, they look at GDP, GDI, industrial production, so even just output is more than GDP, but beyond that, they're looking at employment, income, and sales. And especially employment has been pretty strong this year, adding about 450,000 jobs per month, which does not scream recession. And if you look at previous recessions, like the 2001 recession in particular, that recession didn't see back-to-back quarters of GDP declines. It was kind of up and down. But beyond that, you do see, in those cases, employment coming down, industrial production coming down, income coming down, sales coming down, which we don't have right now.
Right, so I guess it all kind of comes down to what kind of headline you want to write, I guess. Let's talk about recession forecast, because even going into it this morning, across Wall Street, it was a mixed bag.
Mm-hmm. Yeah, there's, kind of whatever you want to look at. There's, you can get your view that there is a recession coming or that there isn't. So on the one end, there are, models showing that there's a 40% chance of recession in the next 12 months or so, but they'll have, historical kind of false alarms. And then on the other hand, you have things like the SOM rule, which looks at how much the unemployment rate has come off its its 12-month low. And so that is 0 basis points off its low. And so that's something that needs to typically rise 50 basis points from that low to get to that point. Alongside the yield curve is kind of the perfect example of both sides, where the 2s and 10s is inverted, but the 3-month 10-year is not inverted. And so that one actually, the 3-month 10-year, tends to be a better indicator of recession than the 2-year 10-year.
So is the bond market suggesting that recession risk might be higher than it was a few months ago? I
think that's true. Yeah, that's fair to say, especially with the 10-year Treasury yield was up to about 3.5% earlier this year, but now it's come back down to 2.7. So that's kind of suggesting that the Fed might have to either cut its rate hike cycle short or just reverse course if they're slowing to the degree that a recession might happen.
Right. So really the two key things that we're looking at then, of course, is going to be employment and consumer spend.
Yeah, that'll be big to see, and consumer spending was still positive in Q2, so right. that kind of kept things going, but it was inventories that were the big drag that kind of helped us see that negative number for Q2.
So we'll have to really focus on what Q3 says for us. All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.